Hey everyone, let's talk about interest rates. So if you're a saver and you're Googling trying to find the best place to get high interest, you're Googling for like high yield savings accounts, a CD, maybe even a money market account. And when the bank shows you their rates, they list it as an APY. So for example, they might say, if you deposit $1,000 with us or more, we will pay you 5% APY on your money. So 1,000 times 5% is $50. So if you keep that $1,000 in that account for the entire year, by the end of the year, you will have earned $50. But sometimes we're not able to keep our money sitting in one place for a whole entire year. So let's look at the calculation to understand how banks actually calculate your interest on a month-to-month basis.
All right, guys, let's do the math. We start with $1,000. We have a 5% annual percentage yield. Annual. 5% annual. So we have to divide that into a monthly rate. 5% divided by 12 is equal to 0.41666, which means the monthly interest that you're earning is multiple of 0.004166. So in month one, you start with $1,000 times that monthly interest, you earn $4.17 in month one. Month two is compounding interest. Great. That interest rate that we earned before is now added to the principal. $1,004.17 times the rate, $4.18. Boom, we repeat the process for month three. Now we have $1,008 times the rate, $4.20. So let's say you have to pull your money out after 3 months because you have an emergency. So after 3 months, you earn $12.55 in interest, but your real rate is that monthly rate times 3, which brings it down to 1.25%.
Okay, so on top of all that, understand this. When the Federal Reserve Bank decreases rates, the banks are the quickest to respond to that and they follow suit. So while you might think you're getting your 4 or 5% interest rate, boom, overnight, the banks have decreased their rates. They've already started doing this months ago. Interest rates are going to keep going down. So is it really worth it? Now you thought you were getting 4 or 5%, now you're getting 2 or 3%. And now we actually see what that real interest rate is if you don't keep the money in the account for that whole entire year. Are there other alternatives? Guess what? There are. But anyway, follow me for part 2 to talk about CDs. Let's talk about. Welcome back to part 2 of talking about interest rates and saving your money. So in part 1, I challenged the idea of chasing interest rates because in reality, banks do drop rates and the APY you think you're earning, you're actually not earning if you don't keep that money saved for the period of time that you should have it saved for. So some people will come to me and challenge me and will say, well, Shantae, I'll get a CD. I'll get a certificate of deposit. Those are better to save in. My interest rate is actually locked in, right? Well, not if it's a callable CD.
So what is a callable CD? These CDs are typically called by the issuing bank when the interest rates move lower, allowing the issuing bank to stop paying CD holders more than the prevailing rates. What does that exactly mean? If your CD is called, you will miss out on interest returns that you would have received had the CD reached its full term. But you do get the interest your account has accrued up to that point along with the entire initial deposit.
So is this a good deal? If the bank calls your CD early, you'll probably earn very, very little interest, if any at all, and you've wasted your time. Join me in part 3 to talk about a possible solution to everything we just challenged. Hey guys, you made it to part 3. You are a learner. You're really trying to learn how to save and grow your wealth wisely, which is all I'm trying to teach you. I just want to educate folks. So anyway, we've been talking about interest rates. We've been talking about how a lot of people have money sitting in bank accounts, savings accounts, earning little to no interest, CDs, money market accounts, not really growing a whole lot of money, right? Let's talk about an alternative solution. Now, first of all, I'm not a banker. I'm a financial advisor. Big difference. So my job is to solve problems and offer you alternatives and solutions that you wouldn't even thought about or even know that's out there. And I have one for you. If you are chasing interest rates and you're tired of trying to have to open new accounts, move your money over, and you don't know what your interest rates are going to be, there is a financial solution out there that not only locks in interest rates, it gives you guaranteed growth. Very few instances as a financial advisor where I can use that word guaranteed, and actually for a period of time, 3, 5, 7 years, where the interest rate is locked in. There's no callable crap. It's guaranteed. The interest rate is locked in and it does not change. On top of that, there are solutions where the money is not invested in the stock market. So guess what? we don't have to worry about market losses. We don't have to worry about losing any monies that you actually save. And a couple other features that I really like is that the interest is compounded daily, not monthly that I talked about in part 1, daily. That means your money grows faster and quicker. And you don't pay taxes on that growth until you actually pull the money out. Like, boom. What else do we need to solve? What else do we need to solve? And sorry guys, I can't tell you what this type of financial solution is because number one, it's not for everyone. This solution does not make sense for every single person. If you're close to retirement or in retirement, absolutely, it really does. But anyway, if this really resonates with you, if you want to learn more, click the link in my bio, schedule a consultation with me, and I'll be happy to talk with you about it. I'll be happy to see if it even makes sense for you. But I will say this in all seriousness, interest rates are decreasing, and even with the financial solution I'm talking about, eventually the rates will decrease as well. So you want to take advantage of this opportunity now. You want to lock in those rates while they're still this high because we don't know what's happening. It's a lot of economic uncertainty. It's an election year. Get some safety. Let's make some smart money moves with your money, and I can help. Anyways, follow me for more financial tips and resources. Thanks everyone for watching.